Earned income versus ordinary income, qualified versus non-qualified dividends, NIT, AGI, MAGI, taxable income. These are all terms that are foreign to most financial advisors and many business owners. But if they're not all coordinated, it ultimately means more in taxes that you're paying. We're joined today by Chris Makin, who's the head of our tax division at Delta. Chris, before you joined Delta, you were at a CPA firm where you didn't work with in-house financial advisors. Can you kind of talk about some pain points or missed opportunities that you typically saw?
Yeah, I think what we'll see a lot are transactions that occur during the year on the financial advisory side that we're just not aware of on the tax side. So when we're filing a return, we will look back at what happened over the course of the previous year. And if that transaction's already occurred and the years passed, there's not a lot we can do with it. There's been instances where we've had large capital gain transactions throughout the year that we're not aware of until we're filing the return, which leads to a bigger lump sum cash payment at tax time. We've had instances where we are in a lower tax bracket that year. We've got some opportunity for Roth conversions to fill up those lower brackets that we weren't aware of on the financial advising side, the full picture. So just having those conversations throughout the year and having accessibility to both sides is generally really helpful for clients.
Yeah, it's a great point. I'm thinking about a client that we work with where they own their business. They also have real estate, and with bonus depreciation that's coming on, with them married filing jointly, their spouse is very heavy. They're a real estate professional, right? So the depreciation from them owning that asset, it's actually going to shield a part of their income. And it opens up opportunities for us to say, all right, should we be doing some additional IRA conversions? Is this actually a good year for us to do capital gains because we're taxed at 15 as opposed to 20? Just, being proactive in that advice and knowing how the entire financial picture affects the tax return is really critical.
Yeah, at the very least, if we know that these transactions exist, we have a longer runway to cover the tax liability.
That's a great point. That's a great point. We'll talk a second here to talk about proactive planning versus being reactive. I think a lot of times what we see from clients who join Delta is they say, it's very difficult to have my CPA coordinate with my financial advisor. And look, I think at the end of the day, it's because they are two different types of mentalities. A financial advisor is always like, look, we got a pile of money. We're going to grow this. We're going to grow, grow, grow. Whereas when you are doing a tax return, we're kind of like inherently on defense, right? We're like, hey, we're going to file stuff, make sure that it's done right. We'll make sure we don't trip up. It's a little bit more difficult to be like on the offense, if you want to say, in that regard. So when you're talking about planning and being proactive in planning, can you kind of talk about how we've worked together in the past to lead with solutions and not problems for our clients?
Yeah, I think as we've talked about before, just knowing the client's full picture on both sides, knowing whether this is a good year to make some Roth conversions, or if we have an instance where clients are having large transactions that we're just not aware of, having the accessibility on our side is really helpful because we're able to plan for that proactively. And like you mentioned, we often have different goals on the tax side, financial advisory side. On the tax side, we're looking to reduce your tax as much as we can. On the financial advising side, there's different transactions that occur there that don't necessarily align with that goal. Still great for you financially overall, but in terms of our expected tax picture, it may line up a little bit differently from what we're expecting throughout the year.
Yeah, I'm thinking about one client in particular where unfortunately, their last parent that was remaining was about to pass away towards the end of the year, and we knew that things were not going well there. So then we instantly know, okay, starting next year, there's going to be an inherited IRA. There's RMDs required from that. We also knew that there was kind of some real estate income that was coming in, and you start to look at it and you go, okay, the IRMA is going to be ballpark right about here. If we have additional capital gains, they're going to be now paying more for Medicare and getting virtually the same service, right? So what we actually did in that scenario is you essentially prepay the taxes. And we talked about it. All right, look, let me use Apple as an example, right? Apple is a highly appreciated stock. Let's actually sell it this year, knowing that we're going to have RMDs that kick in next year on the inherited IRA. And by having that tax return and really having kind of a 3-year tax plan, it allowed us to lead with a solution and say, hey, we can save you, I'm going to use round numbers, like $1,000 in Medicare taxes solely by really cash flow game planning around when we're going to make these sales and looking at the entire picture.
Exactly. And here at Delta, having everything in-house, that allows us to have those conversations a lot more frequently, a lot easier. We're more accessible to one another, and we don't have to worry about grabbing some time on somebody else's calendar and not necessarily being a high priority conversation to have.